All right, joining me now, I've got the president of National Mortgage Funding, Steve Frost, to talk about this new conventional 1% down mortgage loan program. Steve, thanks for joining us.
Thanks, man. Thanks for having me.
Yeah, so let me tee this up for the audience real quick. So I'm going to share my screen, and can you see my screen okay?
Yeah.
All right, so a report just came out, and it talked about United Wholesale Mortgage revives the conventional 1% down mortgage loan program. And here's what it said. So on Wednesday, the Detroit based lender announced that it was reviving the conventional 1% down loan, which allows home buyers to purchase a home with 1% down. Known as the conventional 1% down product, is essentially a 3% mortgage in which UWM pays an additional 2% up to $4,000 on top of the borrower's 1% down. This gives the borrower a total of 3% down payment. Now, before we jump into this, Steve, I just want to talk about what Matt Ishbia said. He released a statement. He said, "We're bringing back the conventional 1% down to give independent mortgage brokers a competitive edge with borrowers and real estate agents, while also helping to make home ownership more affordable." So what are your thoughts? What are you seeing in the marketplace? Is this helping? Is this hurting? When this came out Wednesday, there's a lot of real estate agents, a lot of mortgage loan officers that were like, that thing's dog shit. Nobody cares about that. Nobody qualifies for that loan. How are you seeing this new product?
The same way I always see free money for borrowers. You know, it's a damn good thing depending on how you use it, if you know how to use it, right? So I'm assuming the criticism. So the first point of criticism is, that nobody's going to qualify for 50% AMI, right? And so if you look at what you can look that up on, you can just Google Fannie Mae or Freddie Mac income limit calculator, and it gives you a map. Like, so the market I'm in here in Michigan, right? So our 50% of the area median income limit is $45,000 a year. And people just can't get it through their head. They're like, nobody makes that little money. And if you make that little money, you can't afford a home. And it just, in my opinion, call it closed-minded or call it whatever you want. But for somebody that's been doing this for a long time and I've seen it all, right? Like, I've been through every weird issue at closing, which means when there's issues that you solve at closings that are weird, you can use those as benefits later. And so the first thing is the $45,000 a year in my market is $22.50 an hour. That's a decent wage. There's plenty of people out there that make $22.50 an hour, right?
So, and that is the income limit you're saying, because this loan product has some certain qualifications.
Exactly. So in the market, so that's like three prominent counties. Now, some counties it might be $42,000 a year, maybe it's $21.50 an hour, whatever it might be, right? But just to give like a broad example, in that area median income, like if you typed in your address, Brandon, for your house, it would come up and say the area median income for Oakland County, Michigan is like $90,800 or something. And then so you just take 50% of that. And there's all kinds of different levels, right? Because there's different lending programs for what percentage you are of area median income. And what it is, they're just all tools to make homeownership more attainable for people. And again, not to get way off topic, right? But like if you look back at what borrowers are like, their mindset today is, especially when there's two people on a loan, they have a very high tolerance for payment, but they have very little cash. And if you look at like any economic data right now, like credit card balances are going up and cash savings are going down. And so anytime you can take a transaction like this, where you're getting a grant, like this is like, there's no housing counseling, there's no silent second mortgage, there's no down payment assistance BS that you have to meet. There's no like marginalized demographic requirements that you have to meet. There's none of that stuff. They're saying, okay, if you can get if your income is this, you get 2% or $4,000, whichever is lower. And that's the bottom line. And so for anybody to come back and say like, this is dog shit, or this doesn't make sense, or this isn't usable, they're just not being creative. There's a ton of different things. And you can look at people that have the 3% down, and maybe they have the money for their closing costs. They're like, well, this doesn't apply to them. They have the money. It's like, are you insane? Like, you can buy 2 points with that for free from the lender. So now maybe they're getting a 0.5% lower rate. Or like I told you about the other day, I had a client, same thing. They had like, it was like $4,400 in credit card debt. And they were looking at houses that were like 205, 210,000, and they were pretty much maxed out at that point. Well, I was like, well, if we look at taking that $4,000 and we pay off those 2 credit cards, that opens up another $160 in monthly payment. Knowing you have the 3% and the closing cost covered, we can use their $4,000 and get you guys into a house at 230,000 and have it meet the qualifications for your ratios. So there's all kinds of different. It's a free $4,000 or 2%.
Yeah, I don't understand why people in the industry would push back on this. I think that I don't know if other lenders have started to offer something like this or not, but I think when I saw this, I said, this will just help buyer demand. This will help people get off the sideline potentially and continue to push this housing market forward. And to your point, the report also said to qualify for this, home buyers must have an income below 50% on that area median income, the AMI. To your point, they have to have a minimum credit score of 620 and a 97% LTV to be eligible. So yeah, why one would dismiss this as not being an option, I just don't know, because the way that I'm looking at this, I agree with you 100% in that this just helps more buyers get into more homes. Why one would downplay this or potentially say that this is a bad thing for the housing market or the real estate market, I'm still scratching my head.
It's people that love participation trophies, right? Like if I can't use it, if it doesn't work for this group of people, then nobody should get it. Or if it only works for this group of people, everybody should get it, right? Like, give me my trophy too. Like, this is set up for people that don't make a ton of money. This is for the impact demographic for this is low income earning people. Now, this is a part of it that people miss. And so, and I deal with these. So again, being that our business is focused heavily on purchase business, is that for this type of program, I can have somebody that makes $90,000 a year use this program, depending on how their income's structured. So like, you don't have to use bonus income. You don't have to use commission income. You don't have to use overtime income. So as long as their base income is that amount, then you can use just that base income on your application. Like, this is not sidelining any guidelines or anything like that. This is just saying this is their base income. They don't base any of their budgeting on overtime, bonus, or commission, because that's just their conservative financial nature. So we only use that base income on the application, and that person can use that loan. That, again, because we're only qualifying off of $45,000 per year in income, it's essentially limiting you to like a $1,700, $1,800 a month housing payment, right? That's going to be like 50% of your debt to income ratio. But still, that's getting you can still get a very, depending on where you're at, you're in that like $200,000 to $250,000 range. And if you're a loan guy or you're a real estate agent and you don't play in that sandbox, then I totally get it. But I know very few agents and loan guys that turn down $225,000 or $200,000 transactions.
Yeah. Well, and I think that, you hit the nail on the head when you said for home buyers, it's all about monthly payment. And the challenge for people getting into a home in many cases is coming up with that cash due at signing. It's that down payment that causes people to have to continue to rent. So my question for you, Steve, is how big of an impact do you think that this product will have this spring and summer as we move into home buying season?
So I think further in that article, they said they've got applications starting to eat up $20 million. So if you do the math on that, is that 100,000 transactions that they've got scheduled for that? If you do the math on it, I mean, that's a huge impact. I've used it twice already. So I have people in process. I have people in process. I just flip their loan to that product. So
that's amazing.
It is. It's a box that you check. Like, hey man, like I'm doing it now. I have a teacher, and then her husband is he's like a recruiter for Aerotech, and we dropped her income, we dropped his salary, we dropped his commission. They found a house in a certain budget, And now we've got an opportunity for them to go into it with a lot less money out of pocket, $4,000. It's a higher purchase price than that, but they've got a lot less, they're bringing in $4,000 less to closing, use it for, especially in this market, because you're not getting concessions, so whether it
Yeah.
be covering some closing costs or getting a little bit of, having less money to closing, more money in your pocket when you move into a house. Because again, if you think about this market that we're going back to, right? Like we're going back to the listing agent walking in and seeing like your screwed up paint job. Like, hey, in this market, you don't need to get your house painted. Like let the buyer do that. It's going to sell anyway. Good
Yeah.
neighborhood. It's a ranch, 3-bed, 2-bath. Like don't worry about the paint. They're not even looking at that, And so this can paint a house or can, just keep, like you said, keep money in people's pockets.
How many real estate agents know about this? When you're talking with agents out there and the agents that you're working with, are people aware that this 1% down opportunity is back in the market?
So, yeah, yes and no, right? So again, there's plenty of data out there saying why it's a good thing. A lot of them are still like, I don't know that it's going to apply to anybody that I work with. And again, it just takes that deeper dive. But there's I would say it's like a 50-50 awareness thing.
Yeah.
The professional,
Yeah, and the thing is, whether it impacts a client, you, not you, Steve, but a real estate agent or a loan officer that's listening or watching the show right now, whether it impacts your client right now or not, I think the greater opportunity is to, in fact, communicate this to your audience. This might be a great opportunity for you to use in your email newsletter. This might be a great opportunity for you to make a YouTube video. This might be a great opportunity for you to provide value in the community. Maybe you do a live webinar, and because this is a positive thing that can only help. There's no downside to this coming into the marketplace other than if it doesn't apply to you, beautiful. There are other loan products for you, but it'll be interesting to see how big of an impact, how much this will actually help the housing market this spring.
right? And I mean, here's the thing. So for anybody that's dealt with down payment assistance and grants and all that stuff, right? Is that there are some of those products that'll give you $5,000. You gotta have a 640 credit score. You're required to do an FHA loan, and then you have to do housing counseling for like 2 years. Like you go through like an 8-hour webinar, and then you have to talk to a housing counselor about your feelings.
Yeah.
Like, is there anything worse than talking to a housing counselor that doesn't want to be there anyway about your feelings and home ownership in order to get $5,000, which, by the way, is a silent second mortgage. So if you want to refinance that loan or you want to sell that house, you're paying that money back after you've talked about your feelings and done all that nonsense. Whereas something like this is it's literally the easiest way other than the one hurdle, right? It's that 50% of the area median income limit. Not everybody's going to qualify for it, but a lot of people do. I mean, and you don't see as many pay stubs as I do, right? But the way business works today, you own businesses and you know how this goes, is merit-based pay. Like you're very rarely are companies out there paying massive salaries anymore, unless you're like a drug company or, something like that. Like most
Right.
jobs these days are paid a fairly low salary and then it's heavy on the merit pay, right? And so if you get in there and you really work hard at, figuring out what your base pay is, can we get rid of some debt on your credit report? Because you are making other money. Can we move some things around? We'll get you a free $4,000 for playing, I don't know, what do you call like Tetris with some of your debts and your finances. Then it absolutely makes sense. And you would be a fool to be like, this thing is not a good thing for the market. Like you'd have to be an idiot, honestly.
Steve, we appreciate you like always, my friend.
All right, man, take it easy.